Let me take a moment to introduce our guest for today, a very famous and humble personality, Vikas Khemani sir, CA, CFA, CS, founder and CEO of Carnelian Asset Management. He has overall 25 plus years of capital market experience. So prior to Carnelian, he was CEO at Edelweiss Securities Limited. In his 17 years at Edelweiss in various leadership positions, be it institutional equity or equity research, he had built and incubated many businesses. And he is known for maintaining very strong relation with the corporate India, also associated with industrial bodies and committees, including CII, National Council on Corporate Governance. And he's a member of YPO, which is Young President Organization, basically a global forum for entrepreneurs and CEOs. And apart from that, he is an avid reader. He also do meditation on regular basis. He likes to play poker, and from if I'm not mistaken, from last 2 decades he is a regular participant at various marathons, and he also motivate people so as to stay healthy and work on that. So very very warm welcome once again, sir.
Thank you, Prince, and thank you for hosting me and for the nice introduction.
Thank you, sir. So to start with, sir, like the very basic question we always like how it all started for you, and in last 25 years, how had been your journey? How did you start, and how it has evolved? And yeah.
So I think I started. I mean, I was always interested in sort of capital markets. So I used to track even when I was student in my sort of college days, and those were the days of Harshad Mehta boom, early 90s, and so that's how I used to sort of. I got attracted towards market because I saw a lot of people making money, and I come from a very middle class or lower middle class background. So that idea of making money always excited, and I started studying it, and initially took borrowed some money from my father in the boom, made some money and lost all of it. So felt very bad about it, and that is when I decided that I want to. And those days I used to live in Surat with my parents, and that's how I decided that I want to understand this thing very well. The hurt of the loss was very big, so I said I don't want to do anything unless I learn something properly, and that's where I came to Bombay, did my CA, started understanding capital markets, following it, and then then did couple of corporate jobs, and of course side by side learned, read about what it takes to be sort of good investor. How do you learn what to do, what not to do? So the journey has been long, and of course it's been interesting journey. So along the way, of course, I like you said, I worked with Edelweiss for 17 years, where we built research. So when you are building a research platform, you go into deep to understand what it takes. Lot you study theory, you study practical part. So you read a lot of other people who've been successful in the markets, globally, locally. So there is a lot to learn. I mean, this is the one field where learning never ends. You can keep on learning. So the journey has been very good, and it has been very very super rewarding on every count. Knowledge wise, financial wise, every count it has been super rewarding, and it's true for many participants in the market. So I'm not the only one.
Right, great, sir. So, sir, what has been central to your investing and I mean framework per se? Because you have always believed in the process, right? So, what is central and how you go about say? I mean, mm, as far as like personal money is concerned and the public money which you manages, how the thought process goes behind that.
So I think before I started Carnelian, the journey was largely around because most of my earlier journey was advisory businesses, but so it was only around personal investing, which was sort of great in many ways. But I think as we start managing third party money, you put a lot more structure to what you're doing. You articulate your thoughts a lot more. sharply than what you were doing earlier. You were doing intuitively a lot of things, but when you put down on the paper, the articulation becomes super sharp, and then it becomes a lot more clearer. So when we started Carnelian, that is what we did. And uh, you know and what I've learned, in whatever small journey I have had, is that in equity investing, um, large part of the money is, or to be successful, as even Charlie Munger says, that you have to avoid mistakes, you have to avoid unwanted risk, and you have to avoid stupid sort of errors. And if you avoid bad outcomes, good outcomes will anyway take you far. So hence the risk management becomes very, very essential. So risk management is of course one of the very, very important pillar. What not to do, how to avoid, what to avoid, is very, very important. And second is, again very important, is that growth. Because money becomes, you can make big money only from the growth. You never make big money by only doing value investing, or by buying something cheap. You make money when company grows, and grows over a period of time, right? Compound for a long period of time. That is where you make big money. So my most of the success has been always based on companies where you have found a long runway for growth, and then staying invested for long, and of course managing risk. So risk and growth are the two big pillars, where I always sort of spend a lot of time, and we continue to spend time. And these are two such subjects where you can kind of keep going on and on. It's never ending.
Great, right, sir. So, Sajal sir, you wanna come now?
Yeah, hi, thanks, Prince. Hi, Vikas. We have been eagerly waiting for this session. I see Aditya as well. Hi, Aditya. Hi, everyone. Hi, friends.
Hi Sajal, hi Aditya.
So no, we just wanted to hear you out, and you brilliantly mentioned those two very critical points. So risk management, definitely first and foremost, and you also want the growth after you have bought this stock. So both things are, I think, very valid. So I have got one or two questions, but I can take them. I've got a hard stop maybe in another 40-50 minutes, but I just want to hear you out, because by more than anything, and I'll jump in with my question or two. Um, I can do that right away or maybe later on, whatever. I mean, yeah. But otherwise, I'm just here to listen your wisdom more than anything.
Oh.
Thank you.
Sure. No, thanks. I mean, feel free to shoot any question, not an issue. So, let me, so Prince, if let me just kind of elaborate a little bit more on these two pillars, how we sort of put more focus. So, risk and growth, and let me elaborate a little bit more. So, risk essentially is first, let me talk risk, because risk is very, very essential part of the investment management. And one of the around two philosophies of the risk management is that we are in the business of taking risk. You can't avoid risk, but whenever you take the risk, and risk reward has to be in your favor. So risk reward of anything has to be there. And secondly, to manage risk, you have to know the source of the risk. If you know the source of the risk, then you can always manage it well. So around that our philosophies are built. So we look at risk into broadly three parts. If you see, what we call type A risk, type B risk, and type C risk. Type A risk is the risk of total loss of capital, meaning after you invested, you lose 80 to 100% of your capital, right? If you see, source of this risk is only twofold, broadly speaking. 98 to 99 to 100, well, almost very close to 99.9% time, only two reasons you will probably lose your 100% of the capital. One, when you bet on inferior quality of the management, कि खराब आदमी का मतलब, you put money on people, promoters who are crook, or you don't know how. So inferior quality of the management is a very, very sure source of loss of capital. You can never come back. Secondly, you invest into business which is prone to disruption. The business has some or other disruption is facing, and then eventually it will die. If you avoid these two situations, there's a very, very, very high chance that you will not lose your capital. You might make less money, that's a separate outcome, but you will not lose your capital. So type A risk is that risk. And that you can avoid. There are a lot of methods to do that. How to identify good management, doing forensic research. Some people do scuttlebutt, some people do channel check. I mean, there are different ways of, we have our own way of doing lots of work around the assessment of the quality of the management, and we can speak about that later. But business which are prone to disruption, wherever we think that business are going to prone, there is a chance of getting disrupted, you stay away. You don't have to necessarily be part of those businesses. You can always stay away. And we never buy just because there's a bounce trade and all those things. Those are things we avoid. So that is type A risk. Then comes type B risk, which is risk of mark to market losses or volatility risk. Source of this risk, if you see, could be anything: political event, geopolitical event, any some macro issue happening, some pandemic happened, anything which happened, which can come by. You cannot predict it, you can't manage it. This risk is very real for people who are either day traders or leverage players, because they have to manage this, because this risk is unpredictable. So that's the reason a lot of people have different tools to manage that, but we don't do that. And for a long term fundamental investor, this risk, according to me, is not very relevant. Then comes type C risk. Very interesting risk is risk of opportunity loss. Meaning, you should have invested into sector A, stock A, but you invested into sector B or stock B, thereby generating suboptimal return. Right now, this is a notional risk because you don't lose money, but this is the potential money you could have made. So we call it risk of opportunity loss. Now, what is the source of this risk? Source of this risk is again twofold broadly. One, lack of knowledge. If I don't know where the trend is, where the business opportunity is going to be, if I don't sort of have that knowledge, how will I tap that? So that is one. So you have to acquire constantly what's happening, read, connect the dots, chat, figure out. So lack of knowledge is a very essential part of this. And the second one is a very important source of risk is, this risk is long held human biases. All of us have some or other bias. Those biases come in our way of acting rationally, despite knowing that we are acting irrationally, but still we do act right. I mean, a very common example I give you, this happens to everybody. Let's say if I bought stock at 100 rupees, it goes down to 80 rupees. I realize that I made mistake, it was a wrong hypothesis. I will still wait. At, one rational thing will say, boss, invest, sell this out and get into some opportunity where it's better, where you can make money. But people will still wait for the price to come to 100 so that I don't lose money, and I at least get cost to cost and then invest into something else. I mean, I have seen smartest investors also suffering from something like this, and many more biases. So how to stay objective, how to sort of avoid biases? So these are the two sources of this risk, what we call opportunity loss risk. So we spend a lot of time on at least type A risk and type C risk, and this is not easy. It requires a lot of work, but at least when you are aware, when you are constantly working on these things, you have a framework to deal with it, your outcomes are sort of constantly getting better and better. So that is how we see the risk part. Now coming to the growth part, at least again, how do you look at growth? So at least in our framework, and some of you might even have kind of visited, I saw on Twitter some people were asking some questions, so I thought let me elaborate that. And it's there on our website as well. But so growth, again, we look at broadly in three parts: what we call magic basket, compounder basket, and opportunistic basket. And this is a name given. But so what is magic? So again, in investing, one thing is I have seen big money is made when you invest into stock where you get both earnings growth and valuation re-rating. So if there is EPS of 10, which stock price is 100, P is 10, EPS becoming 10 to 20, but P remaining 10, stock price will become 200. But if EPS goes from 10 to 20, P also goes from 10 to 20, stock price becomes 400. Right? So how do you get both earnings growth as well as the valuation re-rating? That is where you make big money, and that's where I think there's a lot of interesting opportunity lies. And at least I have personally and in our fund also made many success stories around something like this. And that is where we have a little framework again, that how do you identify companies consistently under magic basket, right, or magic stories, or where you can get both earnings growth as well as the valuation re-rating, right? I'll give you an example. There are many situations this happens, but we have created our own framework. But one such situation is, let's say, good business, average management team or poor management team, and hence markets are kind of not liking the business, and it's kind of not liked by the markets. And change of CEO happens, or change of management happens, and you believe after doing your work that the new CEO, new management team can get rid of the issues of the past and deliver in the future. You will always see this followed by, if they deliver, it is followed by earnings growth, of course, comes, but also re-rating. Like our largest holding in our fund for last 3.5 years has been ICICI Bank. Example, when we bought, I mean, we all know that what ICICI Bank was suffering for good 10 years. Then in 2018, Sandeep Bakshi took over the as a CEO of the bank. And I remember meeting 6 months after that, and in 6 months, what he could achieve was phenomenal, according to me. And we were super impressed in what he was doing. And after doing our work at a multiple level in the bank, we were super convinced. But most people that time did not like ICICI Bank. That time it was available, I think, slightly below one-time book value. Now, fast forward in 3.5 years, stock price has become almost 3.5 times. One-time book has become 2.5 time books. So valuation re-rating has happened, and book accretion has happened. So when both happens together, you make same last part of the return. If you look at historically, TCS went public in 2005 till 2009. It didn't make any money, but in 2009, Chandra, who is the current chairman of Tata, he took over as the CEO of TCS. That time, company's market cap was 50,000 crores. PAT was 5,000 crores. PE was 10. And Chandra sir, I remember meeting him that time. He guided that I want to grow the company into industry leading growth. He appointed 21 CEOs of the companies, split them into 21 parts, and gave them aggressive targets. In 5 years, company's profit after tax went from 5,000 crores to 20,000 crores. 4x. Market cap went from 50,000 crores to 4,40,000 crores. 9x. So you make this kind of money when you capture this kind of both earnings growth. And so like this, there are lots of situations where where this can happen. So we have created our own framework where, and I can go on and on because it's a long topic, and but for want of better time, want of time, I will just kind of touch upon one or two. So like this, there are magic moments which happens in the history of every company. If you track them, you can usually followed by, I mean, I love the stories where you can get multiples re-rated, because that is where the big multiplier effect comes. And then the second basket, where, and so in this, generally I have seen 50 to 60% of my portfolio is always around these kind of names. And then second then is about companies which are very stable, what we call compounder basket, where companies are very stable, very highly, well managed company, good cash flow, good ROE profile, and those companies can give you earning growth for long period of time. It could be 15 to 18% kind of growth, but they may not get re-rated because they are already fairly valued. So here, if re-rating happens, it is more by fluke than by design, but you kind of, that gives you stability in your portfolio. So that is generally, I try to keep 30-40%. So it's a stable, good, high quality portfolio which goes. And the last, always, what I call is opportunistic, which is less than 10% of the portfolio, where you can play with it from a short-term perspective. It could be a special situation, it could be an IPO, it could be anything, which you think can make you money even in 6 to 12 months time. And in being in market, always something keeps coming. So this is how at least we divide the growth framework into. So you have a accelerated growth, you have a stable growth, and you have a opportunistic growth. And if generally my experience has been, if you construct your portfolio this way, you tend to have a reasonably good balanced outcome. So this is the sort of how we look at growth and risk management. So I hope this has given some perspective to the audience.
Indeed, Vikas bhai. And just to add for retail folks mainly, guys, if you go to Carnelian website, there is a menu there in the main menu top section for of insights. If you click on that insights, you've got all the investor letters there, and one in particular that I still remember. It's an old one, so maybe you might find it at somewhere at the bottom of that pile. It's the investing principles. So try to read all of them if possible, but this is the one that I still remember because I was looking at pharmaceutical sector very actively in 2019, and this is one framework that kind of helped me as well. So the whole section in that insights menu is definitely worth your time.
Thanks, Sajal.
No worries, no worries. So, Vikas bhai, one question that I have, and with your permission, I mean, I might take few minutes here. Normally, you don't talk specific, on business news channels because it's not the right platform, etc. But I remember a few weeks back you were on ET Now and you shared the top conviction ideas. It was a long list, I think 8 to 10 different stocks, and one that kind of stood out for me because I've got a vested interest as a disclosure. I've been invested in Lotus Labs since 2019 myself, and I still own it. And the one that stood out obviously was Lotus, and as we know that this business is a mix of commodity elements as well as a specialty, so they've got multiple line of businesses or different, completely different sectors like APIs and ANDAs for ARVs and other generics. Then there is complex API like oncology, and there are some smaller investments which are yet to scale up. So Laurus Bio being one of them, and then they've got this CAR-T small investments, but they haven't got the scale. So I tend to ignore them. Most of us tend to ignore that those smaller businesses. The best business that I like in Laurus is what is the innovator synthesis or innovator CDMO. But there is currently a little challenge that we all find in this business, which is otherwise a great business, is we don't know how significant the Paxlovid or the COVID drug contribution is, because we need to minus that from the base to get to what is a more sustainable base to incrementally project the future growth. Because innovator synthesis, I am 1,000% convinced that this has got a at least a 10-year runway, if not 20. But the challenge that we all have is what is the current base, because they haven't publicly, to my knowledge at least, they haven't, management hasn't disclosed what the Paxlovid contribution is here. And Aditya, please add if I miss anything. So as I see, there are two Laurus labs bundled together as one. There is a good Laurus, which is the innovator synthesis, and there is a bad Laurus, for want of a better word, and purely good and bad based on the business economics, because the business economics of generics is very different from innovator synthesis. So how should we value the commodity or the non-CDMO elements in this business? Because I find it easy to value or validate the CDMO, but that's not demerged currently, right? I'm getting both thali mein pura khao ya to kuch mat khao, which is where the problem is. And the price is falling, which is great, because the lower the price, the better the value. uh,
So I think, Sajal, in these kind of, this happens in every company, every
yeah, yeah,
industry.
yeah,
You know, it's nothing new. I think I like the managements in every business. I mean, whichever segment. This is only one segment, but this is every segment. That's where I was saying the quality of the management plays a big role. That management which can attend to the opportunity which is present at the time, and also morph into the opportunity which is futuristic. So while they're attending the current opportunity, they are also preparing for the, for the the futuristic opportunity. And if I, my little view on Lawless is that it's a very good management. They have been always they well managed the company, and like you said, that they are prepared for the futuristic business. Now if ARV became a very big part of the business, good, it was great. And now market ended up, and all of us, and including market, ended up valuing that business at one point in time sustainable business, and hence gave overvaluation. Now, frankly speaking, was that really management's fault? Maybe not. But so these kind of cycles, mark a partly created by the core industry, secondly also created by the markets, and a collective. I mean, it does happen all the time, right? But I think if you take Laura's 5 years down the line, if we believe API and the shift from China is a 5-10 years opportunity for India, and this is probably, I would assume that top 3, top 4 API companies in the country, and a good management, they should come out well. I mean, same thing in IT we have seen. If I remember correctly, in 1997 or 98, one of the years, uh, Infosys had 25% of the business coming from only one client called GE, and it used to be, very low margin business. And GE further asked them to, uh, cut the price. And Narayan Murthy says that in many of these interviews and in his annual report that time, that it was a very hard call for them to say no to GE and cut off 25% of the revenue of the company. And the stock price of the Infosys that time, if I remember correctly, fell sharply by 30-40%, or actually maybe more. I don't remember exactly, but it fell very sharply because you lose 25% of the revenue overnight. And but he says that built the character of the company, and we went out, and to compensate that, we went all out and built the company, and diversified the revenue base and never had that kind of concentration on one client again. So they took that, and now we know where Infosys is from where they were. So ultimately, if the key faith is that if the quality of the management you know, and you have time on your side, of course you have to have time on your side. So if you're a short-term trader, then you one should worry. But if you have time on your side, eventually it will play out. I mean, that's how at least one sees. I don't think anybody can call out market cycle as well as the industry cycle. If you can call out, it's great, and you are a great investor. But consistently doing all the time will be very hard, according to me.
No, no, absolutely, because अब टाइम की तो कोई प्रॉब्लम ही नहीं है ना इस साइड, अपन तो बैठ जाते हैं, हिलते ही नहीं है. Time is not a problem as far as I'm concerned, at least.
Yeah,
I know in funds, there is always that challenge. It's the relative performance or NAV and all the rest of it. But as a retail investor, if you haven't got time, then you should not be investing directly. You should be, giving money to, the fund managers like yourself. You've got Aditya here and others, or go through the mutual fund route if you can't afford the PMS ticket size. But rather than, you should not try and, be brave and invest yourself unless you
yeah,
understand,
yeah.
in-depth understanding of the entire
Correct,
space.
correct.
No, thanks for that response. Thank you.
Yeah, thanks.
Thank you. So Kaushik, you had some questions, so you can quickly come in and ask from Vikas sir.
Thanks, Prince, for giving me an opportunity. Hello, Vikas bhai. This is Kaushik.
Hi,
I
Kaushik.
just wanted to understand about your framework, Vikas bhai, because we have you have spoken about something called as PIU. It's Canal Investment Framework PIU. Can you elaborate this? How you actually take all the companies and because there are 4,500 companies, we cannot research on all of them, right?
Yeah.
So you have some framework. Can you just explain that more broadly
So
and
it's just an acronym for, we basically in any business, there are three things. I mean, when you evaluate any company, there are three things: business, management, valuation. Right? If you see core of whether to buy, not buy, there won't be any fourth thing. I mean, if you just, most of your effort will be around these three things. So this is an acronym for, P is for business, profit, impress us. So I mean, basically PIU. Profit is for business, I is for impress, which is for management. How do we evaluate the management team? And then, risk reward ke liye, us, you, uh, risk reward, right? Now, so let me come to the business. So business side, essentially how we evaluate whether, whether business is profitable or not. Do they have some sort of cost leadership or some advantage vis-a-vis competition, a different way to say the moat, whether the opportunity size is large or not, whether it is, easy to understand or not. I mean, generally speaking, we don't like many businesses which are hard to understand. And I mean, one of the thing, if you ask me, most of the businesses, things where we have had mistakes is the businesses we don't understand. So you don't understand the nuances of that. So it's easy to understand or not. And everybody has their own area of competence. If you don't have area of competence, stay away. Wherever we have stepped out, we have always had some accident or some mistake. So easy to understand or not, right? So essentially, you look at all those things on the business side. So there's a whole framework we have around uh, you know how we evaluate business. Then coming on the management side, which is impress. So integrity. But management with integrity always create value. Management without integrity never creates value. Again, that was in the part type A risk we talked about. I said that how do we evaluate management? And if you ask me, evaluating management is actually, I would say 60-70% of the effort. If you get that part right, generally speaking, your investment should be by and large. I for integrity, impress. So I am for modesty. We don't like arrogant managements. I mean, I have seen many arrogant managements. One, they will grow fast and then they will destroy the value. We have seen many examples, whether it was Yes Bank or Phone Pay or many of them right now. So they have destroyed value. So you've got to be very, very sort of betting money on which are modest people, passionate. They should be sort of passionate about what they are doing. They should be realistically aggressive. It should not be randomly aggressive. You just can't say we will grow at 30%. Whatever aggression you are showing, are they really passive management will not grow, but aggressive management in a realistic way. I mean, we like that kind of uh, growth profile of the management. Efficient capital allocation, skin in the game, strong governance. So these are and there are some objective methods, there are some subjective methods. So we rate companies on each of them. It's a hard work, it's not easy. So we rate about 200 odd companies, not all. I mean, 4,000 companies is impossible to do. So we do that. And same way around the risk reward, what is the potential, sort of downside versus what's the potential upside, based on our models. So we create, between business management and valuation. And then as long as we get things above a particular scorecard, what we have, then we sort of, it comes into our investable set. Otherwise, we don't do. So again, every investor has their own way of looking at things. But to summarize, it is always between business management and valuation. There's nothing, no fourth thing, in the investment framework.
Thanks, Vikas bhai. And I just wanted to understand some more clarity on this one, because we like in our profession we normally meet the management in a week we at least meet 4 5 managements. Every time whenever we meet the management tries to impress like as an investor like us, and the stories are being sold very profitably. So have you gone through this stage, and like is there anything that have you started eliminating things, or like any thoughts on like how you have filtered on to these ideas?
So see, look again, uh, it's a very, very, very difficult task, that it's again about judging a human, right? Whether he is sometime there, you meet management which are always conservative in guidance and over delivering. So if you meet them, you'll say conservative, अरे growth आ ही नहीं रहा है, इसको क्या देखने का. Then some management will be over guiding, and they are very happy to disappoint. Now you have to judge based on whatever. So you got to look at a little bit of the history of them. Generally, we definitely pay attention to their history, how much they have done, how much they have not done, because history also tells you a little bit, right? I mean, when I hire people I've been hiring people for 20 years. If a person with 8 10 years of experience has not found any sort of direction in his career, there has to be something about him. It can't be only accidents, and so there has to be something about his decision making framework. The same way, if a company has been around, and many times, a company which is around 25 years and comes and says that now I am going to grow at 30%, but in the last 25 years they have not grown, you got to take with the caution, right? So first you pay attention to what is their history, track record. And when I'm saying, it does not mean that somebody who's not grown in 25, I mean, cannot grow. It's just that you got to have your own extra diligence around that. So when sometimes changes come in the company, they might get into a high growth path and they do well, right? So but it's just your diligence has to go what management is saying. So if something is different than what history and the currently tells, you have to be very, very careful. Secondly, what his balance sheet says and what he says. Annual reports tell a lot. Most people don't end up reading the annual reports, and reading annual report does not mean only reading MDA. Lot more behind. So what his balance sheet financials are telling versus he telling, is very, very important to understand. So it's not a straight jacket answer. There are lots of nuances to everything. Many times it's just your feel of the person, because you have been doing for so many years, you can figure out that, so it's also a bit of an experience. But having said that, I mean, since you're dealing with human beings, you will again keep making mistakes. You will again have experiences. The only thing is that how we make less mistakes, how we avoid accidents. That's the constant endeavor, and which comes with experience. And you build your a little bit of framework around, you know, uh, and I do pay a lot of attention to their historical uh, track record.
Uh, thanks,
Right.
Vikas bhai.
Aditya sir,
I'll come in the
Kaushik.
queue.
Yeah, sure. Aditya sir, you can.
Yeah, hi. Thanks for the opportunity, and Vikas bhai, thanks for doing this. Uh, Vikas bhai, I had a question regarding the management change thing. Because as fund managers, we all want to experience that double bonanza effect of the P re-rating and a higher than average, historical average kind of an earning growth. And in my fund, for instance, we have RPG where we have seen a similar effect playing out for us. Really helps the fund performance. Uh,
Hmm.
but there are also my doubt lies in when you meet a new manager, right? A guy who has just been appointed to sort of run the business for the promoter, and let's say promoter is now hands off. And when you meet him, interview him, and sort of ask him questions, obviously his plans are going to be grand. He's going to change everything upside down. He's going to make the world a better place, etc., etc. How do you get trust before you sort of buy into his story? How do you build trust with him? How do you understand whether he'll actually deliver on what he's performing? So that's question one. Question two: does it make a difference if the new manager, if he's an outside professional, or if he's just the son or the daughter of the original promoter? So these two questions, please, Vikas.
Hi, Aditya. Great, I think great questions. I think very clearly, when a new manager comes from outside, of course, he's come with an experience, right? So at least I go and check his track record in the previous organizations. What he has done in those previous organizations. What does I've done this many times. Like I'll give you an example. Recently, in Aditya Birla Capital, Vishakha Mulai has gone to from ICICI Bank now. Now, if you do her track record in ICICI Bank, you make 5 phone calls, you will know what she has done, what was she good at, what was she bad at, and and suddenly you will get a very very good perspective around what she has done, and then you place it coordinate. Put it along with what is the need of the current platform, and if that marries, then you have something good at your hand, right? So same way, I think like track record doesn't have to be in that organization. It's like this again, same thing. If you change a job, in your previous organization, what you've done, have you been successful, have you been rated? Whenever I'm interviewing, so hiring and buying stock is kind of very, I have a lot of, I relate a lot because I have hired so many people in my career. So if I'm hiring somebody, if he has won some awards in his previous organization, consistently as outperformer, I would ask him, what has been your rating in your previous organization? Out of six, if you have been rated 5 and 6, means you've been performer, right? If you've been 3 or 4, then you know what to expect from you. So you can check the person's track record, and many times it may or may not be available. But if it's available, it becomes a lot more easier. And then you see whether the person has taken the why he's joined this place, what is his game. I always ask the question, that why have you joined this place, if you, especially when somebody is coming from a larger platform to a smaller platform. If you are taking a risk of coming from a well established job to a smaller platform, there must be some thought process, because you are also risking that. So what did you see in this? What was your big thought process? Some of those things will really give answers, other than saying तुम्हारा grand plan बता दो. I mean, and again, there's no right or wrong answer, but these are some of the things at least I do. Regarding second question, whether it's promoter's son or not, I mean, I am frankly speaking, it really depends on the setup. I really don't, I don't have anything against being promoter's son. I only have one thing, that capability of the person, whether the person is good enough or capable enough to do the job or not, whether it comes from entitlement uh, uh, point of view, or it comes from a responsibility point of view, and which you can figure out when you interact with the person, in some time. I mean, we all have interacted with people, whether he's coming from how responsible he is. um, you know you can figure out. I don't have anything against, frankly speaking, a professional or a promoter owned CEO. It makes to me no difference, as long as it is capability wise all right.
Thanks, Vikash. Just another follow-up on discipline of investing, right? So most fund managers, including I'm sure both of us, want to sit on cash in times when we know market appears heated or near heated, right? And but you get most of your money at the peak of the valuation cycle, right? So most investors actually give you money when you don't want it, or you don't actively look for it. That's when you get most of the money. And at the bottom of the cycle, you just don't get money, or when valuations are mouthwateringly good because of the recency bias of most individual investors, you don't get money at the bottom. How do you deal with this puzzle? So in my short stint so far as a fund manager, I've experienced problems there. I want to learn from you as to how do you deal with this conundrum where you get cash at the top and you are wanting cash at the bottom but you don't get it. And if you don't invest when you get it at the top, then also even if you miss a 2% rally, there's a lot of backlash from investors, right? So how do you manage this? How do you emotionally, practically, from a portfolio standpoint, how do you manage that?
So Aditya, I mean, this is occupational hazard. You can't do anything about it because, if you see, and this is we have studied something similar thing in US also, in India also, everywhere because this is a human psychology. Most of the larger retail is part of the is generally a herd mentality or herd following kind of approach. The what they call it recency bias, that the comfort with what happened recently tends that it will happen again is very high. So if markets have done well, people would want to put money. If markets have done so, i- in bad markets, the risk per unit of investing, per unit of sorry, when you are in a bad market, return or reward per unit of risk is highest, but the risk taking capability of people is lowest, and vice versa. This, I don't think you can change significantly. The only thing which all of us can do is, when you think there's a euphoria, you start warning people, and maybe you can close fund for subscription. At least we have been writing whenever we think is market is high. Like last year, I remember when that new tech was at the peak, and the everybody was sort of feeling miss out, and we wrote a very nice piece saying that there's a big fad going, fad, FOMO, fade, meaning people are, there's a fad of investing into new tech companies. People are investing out of FOMO, and this will fade away. I mean, this I remember July last year, some July or August last year, we had written, and we kept on warning investors that please be careful. This is not the time. This is not the thing to do. We did not do it. A lot of people told us that you are not investing into new tech. Why? You probably you'll be left out. And we said, we don't, it doesn't make sense to us. And we kept on, not only we did not invest a single paisa on that, but we kept on warning investors that be careful, be careful. So that's all we can do, and hopefully over a period of time, investors will, it's a long game, so over 10-15 year period, people will start recognizing your thought process, that it's a balanced thought process. That's what at least I can say.
Thanks, Vikash. Very generous of you. Thank you.
Thank you, Aditya sir, for your questions. So Vikas sir, like the formalization of economy and shifts are happening from unorganized to organized. So which sectors you see will emerge out as the main beneficiaries of this trend?
This is practically happening in every sector, if you ask me. The if you see this, there are multiple reasons for this shift. One is that regulatory side, that in India we have had this massive reform on the GST front and tax front, where earlier models of which were dependent on the tax evasion of largely SME and all have vanished, and they are no more viable. So one is that because of the regulatory or tax kind of change. Secondly, some technology oriented, so some earlier businesses which could sustain on a low technology, and now the high technologies are coming, or new technologies are coming, which are making the older technology unviable. So regulatory led, technology led, consolidation definitely is happening. So these are two major ones, and then there are small ones which keeps on happening. But if you see under this, most of the shifts happen, most of the changes happening, and that is happening in practically so many sectors as we speak. uh, I mean, right from, I mean, so many consumer sectors, whether it is building materials to packaging materials, to even consumer, within consumer also is happening. So there's so many sectors, you can't really pinpoint even one where this is there. It's there, and it will continue to happen because uh, 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 and there are some sectors where economies of scale are coming about. So you will, this is happening across many sectors. So idea is to just keep an eye open and keep playing out on those. So, but regulatory and technology part is something what one should always keep an eye on.
Right, sir. So, sir, the China plus one thing is still appear to be in a nascent stage. So, the size of opportunity is really big. So, what do you think? Like, will India get the major pie out of it, or how you see it going from here onwards?
So this is a very big trend. See, in every country, I mean, these are the trends which comes once in a while. They don't come very often. They come probably every once in 2-3 decades. I think last such big trend I think India saw was in IT services, which started in mid 90s or started to accelerate in mid 90s, and till date it continues to remain. India acquired the leadership in that, and it continues to remain one of the very large contributor to the Indian economy. Same way, I think India has a very large population. Historically, unfortunately, India did not focus on manufacturing much, and we became dependent on the imports. Our manufacturing GDP is only 16% of the total GDP, which is for a country of $1.3 billion a dangerously low level. Fortunately, government has realized that they want to make it to 25% in next 5-7 years, which is a very ambitious task, because this number was 15% in 2000. So in good 20 years, we could make only 1 or 2% improvement. So it's a very ambitious task, and government knows that. So one is that, so there are two opportunities within the manufacturing space. One is the import substitution opportunity, and second is the export opportunity. And the combination of these two makes it very interesting. So to address the import substitution, government is doing so many things, including PLIs, providing protection to the local industry from unwanted, unfair competition from abroad, by putting non-tariff barriers. Non-tariff barriers meaning government puts uh, some sort of procedural barrier so that people can't sell. Like you must have heard recently that toy import from China reduced by 60%. Government made only one change, saying that anybody who sells toys in China has to have BIS mark. Now whether to give that BIS mark to Chinese company or not is up to them. They can delay it, they may not give it. You can keep applying, and you might not get it even for 5 years. So, and thereby opening the market for local players. So you are giving opportunity to local players from unfair competition from China or elsewhere. So government is doing a lot of things to make sure that local industry thrives, gets created, and from an import substitution perspective, that they've identified about 12 industries under phased manufacturing plan PMP. In 5 years, they want to see imports to be zero, and working very aggressively on that. Second comes China plus one, where we all know that given the hostilities across the globe, importantly between US and China, which is their biggest trade partner, uh, uh, you know, every company has been looking to diversify away supply chain from China. Right now, India becomes one of the most prominent partner of that. Now, I know a lot of people talk about Vietnam, China, Bangladesh, Sri Lanka. Of course, they are there. Vietnam is a very credible partner for that, but India also will give a very large proportion of that, because good part is that in India, we have a very good chemistry knowledge, we have very good engineering knowledge, we have a cheap labor force. In China, labor cost is $800. In India, labor cost is $200. So even if I adjust for the productivity loss, we are still cheaper. So a lot of advantages have been falling in favor of India, and now every company is looking to engage. When we talk to companies, people are saying the number of inquiries which we are receiving from companies abroad is phenomenal. Post COVID, they don't have time. They don't have sort of they are flush with the inquiries. How fast you can ramp up your production, how fast you can cater to that, it takes time. So so it's a long term trend. So today a lot of global companies are setting up global scale plants here in India. Apple is the second largest plant. The 25% of their production will come from India, which is a very big deal. Now people will say, if Apple manufactures here, how does it help? It helps because the entire component manufacturing system builds around it. Like when Maruti came in 82, that time it imported 99% of the parts assembled here. But over the next 5-10 years, They started manufacturing 99% parts in India. The entire auto component industry in India is thanks to Maruti and Honda, because that got built. Now today we are globally competitive. So same way you need to have ecosystem getting built. And as these players starts come about here, India's ecosystem will get built. But this is 10-year, 15-year kind of journey. So I have no doubt in my mind, as India's manufacturing GDP goes from 16% to 25%, there will be many companies which will be 1 lakh crore market cap, 2 lakh crore market cap, which will come out of from this. And they will scale up to become very, very large companies. The key thing is that, and we can't relate to that. If somebody told you that in 1997 that Infosys uh, will be making 40,000 crore profit a year, who would have believed, right? Or TCS will be largest IT services company, who would have believed? This size, who would have believed, right? 13, 14 lakh crore market cap. I don't think people would have even thought in that. It would have looked a very ridiculous idea, that but that's what the whole thing, that when the opportunity comes, when the compounding works for a long period of time, companies grow, companies scale. So many companies within the manufacturing space will become very, very, very large. So that's the perspective one has to invest in that. And if you invest into companies early stage, you can just stay put and run. I have seen in front of my eyes Sun Pharma going from 1000 crore market cap to 3 lakh crore market cap, right, in a period of 10-15 years. So opportunities happen like that only when there's a big tailwind and good companies, and they will come, they will happen. There's no doubt in my mind. It's just that you have to find, and you have to kind of constantly work at it. And so it's a very, 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 very big opportunity from India's standpoint of view.
Right.
Vikas bhai, very very quick question. Can Praj become a large cap over the next 10-15 years? What risk do you see in this story?
So it's a good company. It has a good CEO. Can it become very large? See, it has a potential. Now, it might have a management change possibly. I don't know. Uh, because the current promoters are old, and next generation is not interested. So, and now, now whether it will become or not, that will depend on what path it takes, right? And who it goes to, and so it really depends on that. But it has potential.
Mm-hmm. Thank you. Understood.
Thank you. So, Ravindra, you had a question, so you can go next. Kaushik will come to you after that.
Hey, thanks, Prince, and thanks, Vikas, for sparing time for sharing insight with us. I have one question in terms of we were talking about risk and reward. Say how you see currently market valuation for India, and given the whatever rise we have seen in the interest rate, so are there decent alternative investment opportunity in the debt side, which where the allocation need to be shift after what has happened in last 2 years in terms of low interest rate regime has impacted Indian market as well. And also the second question I had was you were talking about ICICI and then also Aditya Birla Capital. How you put your emotional construct in these kind of investment case when you've seen say peers have outperformed to a very large extent in recent 4 5 years, and put that case aside and make a new investment case for new ideas where you think that these ICICI or say from today's case maybe Aditya Birla, that is a better investment opportunity than many of the other NBFCs, large NBFCs, which has created wealth for 4 5 years prior to say 2022. How you put your thought process behind it, that rather than chasing the wealth creator of the past, I back this new idea.
So again, like I said, that there are two baskets very clearly, right? One is that wealth creators of the past, if you think they can continue to deliver, they will keep compounding, but they will not give you further re-rating. Bajaj Finance cannot become, technically it can, I'm not saying it can, but it's very hard for it to become 8-time books to 12-time books. Technically anything can happen in markets, but I'm just saying that it's very hard. You can't invest, base your hypothesis on, so that's more compounder like kind of stories. But at the same time, there's no emotion involved in when you invest, find a company like whether it is Aditya Birla Capital or anything for that matter, or ICICI Bank in 2019. Is your sheer analytical thing is that you are evaluating risk reward, that the market view is completely against, but you are finding an evidences, you are finding reasons to believe that market would be wrong, market perception right now is not right, and there are some facts which are changing. Now of course you can go wrong also in that, and that's where your ability to take your own conviction and your ability to take what if things go wrong, so that gets addressed into position sizing, and depending on how strong conviction you have based on what data you have, right? So there's no right answer, but it's all, it lies in the objectivity and then the risk reward. Should I invest at one time book company which is growing at 25% over next 2 3 years minimum, versus a company which is trading at 8 time books which is growing at 20%? With second one being over ownership, earlier one being under ownership or no ownership, clearly the risk reward is there in the favor, by a margin or by a mile. So sometimes things become very very sort of stark in your face, but then of course at the end of it you have to be conviction, and in these things you can be wrong for a long period of time before you become right. So you have to really keep your you have to be really thick skinned about it. I mean, you might be wrong for let's say for a long period of time. Sometimes you will be right, sometimes you'll be wrong, but that's what the investing is all about. You just can't pay attention to what others are saying. You have to play your game, what you understand. And I think second question was on the asset. So valuation, I'm not really overly worried about the valuation point of view as far as India is concerned. I think we are not cheap, we are not expensive, we are in a fair value zone. But why India should be cheap also? Because India is the only market where there is a growth potential. India's earning, in my opinion, can grow at 18 to 20% for a next 5 year period at least. Now there will be kind of ups and downs, but on a sort of trajectory basis. I mean, there's no other market which I see. So why should be cheap? It is low leverage. India as a country is not leveraged. India as a corporate is not leveraged. Um, we are youngest country, youngest working population, fully reformed. We have a good stable government. I mean, if you just we have a reasonably vibrant democracy. So why should trade at any cheaper? Right now, in fact, I feel that it is trading cheap because right now India, being part of the emerging market, is not receiving flows. Typically, whenever the interest rates rises in the US, emerging market money is pulled out, and which is what has happened in last 2 years. So today you are seeing India cheap because emerging market flows have not come. Just imagine the day emerging market flows come, India will get re-rated further, according to me, in next few years, because I think growth profile is solid. So I don't think India is going to be ever cheap. And by the way, India has always traded in last 20 years or 30 years at a premium to the emerging market average multiple. So of course, when the interest rate goes up, some amount of premium adjustment happens, and that's the reason. If you have seen, we don't realize in last 12 months Indian equities have not given returns. Now, but in earning growths have come. So what has happened? Derating has happened. This derating is what? This derating is because of the interest rates. Now, as we go forward, in my opinion, interest rates have peaked out. Now, as we go forward, whether it happens in 6 months, 9 months, 12 months is anybody's guess. But some point in time, interest rates will start coming back again as the inflation settles down, and so you will again see growth and a bit of a re-rating happening. So it's a. I mean, I have full faith that India's fundamentals are by far the best in the world, and they're likely to remain so at least for next 5 7 years.
Sure, sure. Thanks. If I can chip in one more question, Prince.
Yeah, yeah, quickly go ahead.
Yeah, just one thing. Say the best known compounder of the of Indian markets, Asian Paints, Pidilite, Bajaj Finance. There is some sense of slower growth. Uh,
Do you think it's just a quarter event, or this can proceed longer? They will grow definitely, but the pace of the growth might slow down from here. And does that make a case for kind of de-rating for those companies from the level they are right now? Any points you want to
So
make
I
there?
mean, we don't own both, but I'm just giving you broader out. I mean, not that I have any sense on the of latest recent quarter numbers and all. I mean, currently there has been 1 or 2 quarters of slowdown across the consumer basket, especially the discretionary, and because of I think high inflation and all those things. So that's the reason you are seeing a bit of a. But I think both these companies are very solid with a good moat, and both have a levers of growth. If India's housing is going to grow, which is the case, uh, you know, and paints is there in everything, right? So I think growth should be there. In my, I see no reason why they will not grow. Of course, some point in time when it slows down, which I think is at least some time away. Now one has to see whether how the competitive intensity is building, whether they can retain the leadership margin. That questions are right now being asked, especially in companies like Asian Paint. But I think still there is some good runway ahead. I don't think it should be close to derating yet, but you never know. You got to be on the toes. But currently, I don't think this slowdown is more structural. Probably it's more tactical.
Thank you, Ravi, for your question.
Thanks
So,
a lot.
so Vikas sir, just wanted to check on time because we are already 1 hour. So can we keep it for another 15 minutes if you allow?
Sure.
Yeah. So my question is like, do you see any slow growth sector moving towards high growth trajectory? Any sector in mind which can be, I mean, looked from this perspective?
I think what destruction we have seen in the entire chemical space, chemicals and API space, in last year, we have seen huge value correction, huge growth correction. Most of the companies are still in the capex phase. I think we are beginning to see risk reward falling into place. In my opinion, we are very closely studying that, and but that I think right now in 21 everybody was just chasing this segment. In 22 I don't think anybody wanted to chase or anybody wanted to invest to the extent that most people don't even now talk about it. So that also shows that how the pendulum has swung, but the sector definitely remains a promising one. So I think that clearly looks like a good contra bet. um, Rest, I think banking and manufacturing seems to be in a good place, according to me. A little bit of skepticism in IT right now is there. I think the demand will continue to remain robust. I don't think there's any challenge, and which is most companies have guided. So I think IT risk reward is definitely in the favor right now, according to me, in especially in an environment which is slightly uncertain. Yeah.
Right. So before coming to Kaushik and Gaurav, let me throw another question. Sir, the desire to perform all the time makes us vulnerable as far as our investments are concerned. So how we should sail through it?
Don't try to desire perform all the time. Nobody can perform all the time. Sachin Tendulkar could not perform. Uh, Amitabh Bachchan could not perform. You pick up any investor, ace investors. Warren Buffett could not perform all the time. So I think one has to be very clear about what game one is playing. Right? It is impossible to perform all the time. While you can desire, but that desire, what is so? If you try to do something impossible, what are you going to get is only disappointment and frustration. Right? Rather, if you keep your expectation low and keep the fundamentals high or intact, that I will play my principles and keep my expectations low, I can tell you outcome is generally very good. People who are consistently or consciously anxious about their performance and the net worth and the uh, you know share price, I think they don't tend to, in my opinion, do well. I mean, in my portfolio I don't look at the price of my stocks for months, for that matter. So it really, you can't perform all the time. What's your objective? You got to be very clear.
Right. So Kaushik, you can unmute and ask your question quickly.
Thanks, Prince. Vikas bhai, I remember you were the first person to go and sit very tight on Praj before even the ethanol story started. Can you explain how this happened, and like how did you eliminate a lot of stocks and then come on to Praj as one of the bet. And also same similar kind of trend that I've seen in you with even ICICI Bank in your portfolio. So if possible, can you throw some light over here? But
So Praj again, I think biggest bet was we bought actually before you're right, before even ethanol story was playing out. We were
yes,
lucky that
yes.
ethanol played out. But our big bet was there's a guy called Shishir Joshipura who's the CEO of the company. He joined in 2019, and I have known Shishir for 15 years, and I have known Praj for again similar period. So the biggest problem of Praj was that it was a solidly competent company, very capable company, huge R&D, and very very poor on the commercial aspect and organizational management aspect. And when Shishir came, Shishir was a very sharp CEO. He could move the mountains. He could get people going. He could bring those business commercial aspect which Praj needed. So I could see an underserved opportunity where a very competent CEO came, and I met him. So why did you join? Leaving SKF kind of multinational and joining like I was speaking some time ago, that what was your motivation of joining this company? He said, because this is a gold mine. Now my answers were clear. So he of course explained, okay, it has, when he was saying it's a gold mine, meaning it's a huge potential. I can do lot of things. There are so many low hanging fruits, huge capability. So you have that answer then and anyway nobody owned the stock. It was not very overowned. So you had full skepticism, change event happening. You know the guy, you know the company, and that's your then winner.
Got it. Got it. Uh, so I think next person can take the question.
Yeah. Gaurav, you can unmute and ask your question.
Yeah, I hope you can hear me. Thanks, Prince, for organizing this space, and thanks, Vikas sir, for sharing your insights. Because sir, you told about like how buying cheap may not be the best strategy because we will have to always look for growth, and that is what creates wealth. So when you try to screen or look out for new opportunities, do you always go 100% bottoms up, or you also have a view of sectoral growth which may be possible, or you take some macro view also while making some your stock selection? So if you can share some insights on that.
Sure. So we have created different filters for each basket, right? Like I was saying that accelerated growth basket under Magic, stable growth. So for each of them, we have our own filters. Like if there's any change of the management, we start tracking it. So if we know the guy, you know, like I said that if you know the guy, then you have the answer immediately. If you don't know the guy, track for some time, right? And then you will know what he's saying, what he's not doing. So it's like that we've created. If there are some structural change happening, which is more macro. When we took a very big call on manufacturing in August 2020, that time people were barely coming out of the pandemic, but we could pick very quickly and connect the dots, saying that what are the changes happening, and we launched a fund which was investing only in manufacturing companies, because we could connect the dot. When we were speaking to 7 8 companies, every company was saying that अरे बहुत इंक्वायरी आ रहा है, एक्सपोर्ट्स इंक्वायरी आ रहा है, जिससे बात करो वो बोल रहा है अरे बहुत इंक्वायरी आ रहा है. So and in, and people were talking positive in that. So we just then enlarged the hypothesis and said, seems like something big in making. What is happening? And then we did more research. We spoke to some more consultant. We spoke to some people, and then did some work, figured out. And so we started from macro point of view, and then say, okay, in India, if this is the theme, then which are the 5 sectors will benefit? And in those 5 sectors, which are the best companies? So, like for example, let's say garment. We saw garment, China plus one garment will be the very big beneficiary of this segment. Now everybody was negative when we spoke about garment. Arey nahi, Bangladesh is very good, China, Sri Lanka is very good. But we said if garment is going to be an opportunity, which is the best company in India, KPR Mills. So we said okay, and we spoke to KPR Mills guys. They were like very very positive. No, business is there, we will grow. So and then same company we bought, that has become in 2 years 5x, got re-rated. So there's no, so you have created your own filter. Sometimes you start from top down, sometimes. So we have created our own filters in each basket. When you are looking for compounders, of course you look at the history of long, how much you deliver, what's the business model, what, and then you start working from those filters. So for each we have created some sort of filters, and then you look for those opportunities.
Uh, Thank you. Thank you, Vikas, sir, for sharing this. I'll just a follow up on this, what you just said. Prince, can I continue with my
Yeah,
question?
quickly go ahead, please.
Yeah, because sir, I think you talked about that. I think thanks for helping us get that perspective. So I think what I am able to relate is that talking to management, getting that scuttlebutt from consultant industry insights that plays a role. But when I talk, when we talk to many other investor, many people just don't talk to management because it may bias their view. So there is one view very opposite to that, and secondly, many retail investors may not have access to those uh, mm, top management. So how do you solve this dichotomy in these two cases?
But see, again, I'm not saying that, see, talking to management is always the answer. But you can also talk to management. There are con calls which are happening. You can read them, transcripts, you read them, what they are saying. The MD annual reports say something, right? They are saying that you can get their mind right. So it's not that, I mean, the reason you talk to management is to try to get perspective what is happening, and because you talk to management does not mean that you believe everything what they say. You never believe everything what they say. You are just trying to get sense from the management what's happening that point in time. If my hypothesis is there that garment is a big opportunity, is turning, and if you talk to company, are you also seeing some inquiry? Probably if I just end up making hypothesis in my own mind and ground पे कुछ नहीं हो रहा है, तो क्या फायदा है? Then so you get to that validation of some hypothesis which you are making from the management. You should never ask management that, oh, next year का EPS कितना होगा, next year का, that is the according to me, or next quarter का. No management can tell you precisely क्या होगा. What you are looking for is a broader trend. Big money is made when you look at the broader, when basically there's a tailwind and you have right management. So when you're asking management questions, you talk to management to know their philosophies. When you talk to KPR mills, what is their philosophy about? And if somebody talks to them 1 hour or listens to their calls or reads to the annual report, your quality of the management will reflect automatically. So you don't need to talk. You just read the annual report, you listen to their calls, you will find the quality of the management. So again, to each his own. And there are people who have done successfully investing without meeting managements. So so there are companies like I'm telling you, we have invested into company like Timken. We have not talked to management. We have no access to management. They don't talk. When we invested, they were not talking. I think they've started. It's an MNC. They don't talk. But if you read the annual report, that gives you the best hint. It says that we will, move our, India will become the global sourcing hub. Now, your hypothesis is being reflected in the annual report. What else you want? So again, you are checking on. So company is very good, no doubt. Capability is very good, no doubt. You know the industry growth number, which is coming about. Your hypothesis supporting. You can invest. So again, there's no right or wrong approach, but we do definitely try to talk to management to know their quality of the management.
That's it. Thank you. Thanks for your insights, sir. Thank you.
Thank you, Gaurav. Nitish, you can quickly unmute and ask your question.
Uh, Thanks, Prince, and thanks, Vikas, for this opportunity. So, I remember, Vikas, one of your interviews last year where you kind of very well predicted that the banking sector will outperform IT for next 12 to 18 months. And, one of the rationale, and you also mentioned that the attrition in IT will come down in few quarters, right? So both have played out very well. So now, do you think both are now fairly valued, and IT will do well over banking? And how do you want to review that call?
I think this year IT will do well. Like I was just saying some time ago, IT will do well. IT growth is coming. Everybody's winning contracts. IT has become non-discretionary for most companies. So IT will do well. I think banking, I guess still there's a runway. Probably in 6 months' time, people will start talking about cost of deposit going up and stuff like that. But I think next 1 or 2 quarters definitely looks still very good. After that, one would review, based on what valuations are there and there. But banking, if you ask me, looks good from a 3 year perspective. Because in my opinion, all large banks or all mid-sized bank or decent banks will double their pre-pop, as they call, pre-provisioning profit. In my opinion, in next 4 years, or maybe max, I mean 4 years, they will double their pre-prop. So at least in 4 years मुझे लगता है कि banking stocks can at least double. Now if that's good enough, great. Otherwise you can play cycle in between, because banking sector will go up and down. It never goes one way, because it is kind of prone to market gyrations on every event. So, but directionally speaking, looks good. In between, one can kind of trade in, trade out, depending on if you are able to do that view. But uh, I guess 2 quarters at least still looks decent.
Thank you.
Vikas sir, like you talked about like for making big money we have to identify a big trend, and there is always an advantage if you are little early. So if coming to the point of opportunity cost, and say if you are little early into an investment, and say something is not playing out the way you have thought, so is there any time stop loss? How long you keep that position, or how you go about cutting it short? And on the top of that, what is the exit strategy which you take, or I mean execute so as to do yourself?
So time stop loss should be on the business, not on the share price. In the sense, let's say you invested in a company which business wise is doing all right. Let's say for next 5 years, business wise is doing all right. It's growing, hypothetically speaking, let's say 15-18% every year. But the stock price is not growing anywhere, right? I won't bother. But if business wise the company is not growing anywhere, right? Let's say you made a hypothesis the business will grow at 20%, 15%, whatever that number was, and it has not grown for 3 years, and you come to the conclusion that something is wrong in my hypothesis, then you should exit. But in the earlier case, in my opinion, either should buy more or stay put. I mean, I have had a situation when I bought a stock in 2005. It was doing well every year. I mean, on most counts, whatever, I was monitoring that. It did not deliver return for 7 years. And as I speak, I still own the stock. So 2005 to 2020, 17 years. The CAGR of that stock is better than HDFC Bank. So what I'm saying is that as long as the business is doing, you can stay put, because your time horizon is not limited. You are not really necessarily looking for validation of the share price in your say if only the share price goes up, then only my hypothesis is validated. As long as the business is growing, business is doing well, whatever parameters you have judged, there should not be any time stop loss. So I think key essential thing is at the business level.
Right, sir. And how about selling your position exit strategy, sir?
Again, the same thing in my opinion. The exit strategy should be two. One is that if you think your hypothesis of business has gone wrong, of course you should go. Second, exit strategy should be there. Many times in our market, exuberance get built, where that uh, the everything is good, but next 5 years growth is already factored in the price today. And you know, I remember last year somewhere when Aarti Industries, which is a fantastic company we love, we used to have in our portfolio, and they did a QIP taking 2028 numbers. Now it is very clear that any company which is taking 2028 number to, I mean, there will be in 5 years some up and down. So why should you remain invested in that company? Because a lot of thing has already been factored in the price of now. So when it becomes that outrageously sort of expensive, and you evaluate based on your framework, that so, and then you exit it. So you exit. So when something is outrageously expensive, given what is the potential future in next 5 years, then you tend to sort of exit. So these are and thirdly, you look at that if a new idea comes and you put in your portfolio, which is better than let's say some existing stock, on a risk or reward basis, either way, then you should replace. So these are the 2-3 things at least we follow. But exit is
So
no, I mean, there's no one science to it. I mean, it's again combination of art and science.
got it. So technicals find any place in that, sir?
Not really, to be very frank. I mean, we don't base on technical except to look at some while the day we are buying, we look at थोड़ा बहुत कि भाई आज खरीदना है, कल खरीदना है, थोड़ा बहुत चार्ट देखते हैं, बाकी we don't pay. I mean, we never make a buy or sell decision based on chart. I mean, it's a technical decision which our trader makes to buy today or tomorrow, something like that.
Right, sir. And so, like, would appreciate if you tell our attendees about the services at Carlenian and like any specific onboarding process or so.
So, we are a boutique investment management house. We do manage money for large family offices in India. And so we have a few products. We have PMS and AIF. We have one fund which is a multi-cap fund, which is called Carnelian Compounder Fund, which invests across the sectors, uh, uh, which has been running for 3.5 years, and it has delivered about 17.5% return post all expenses versus about 14% of index. We have another very unique product, like I was saying, that which we launched in 2000 August 2020, called Shift Strategy, which invests into manufacturing and technology, which are the two big shifts, decadal shifts which we saw, uh, which is going to take place, undergoing create a massive wealth opportunity in next 10 years. So that strategy we have both in PMS and AIF format, which is AIF is raising capital right now. So yeah, these are the two major strategies. Then we have some customized bespoke strategy which we do for large families, which is much more customized portfolio. So these are the broadly three strategies we run. Anybody who's interested, more than welcome, or anybody, your friend or anybody, more than welcome. We can reach out on our website, or through any sort of media. More than welcome.
Right. Thank you. So, guys, like, I mean, any names which were taken during the conversation were purely for illustrations. So, no sort of buy sell recommendation or hold recommendation. So, Vikas sir, like, any good literature you would suggest to our attendees, so as to, I mean, maybe on investing or maybe non-investing also.
I will investing तो सबको पता है यार. I will suggest everyone book called Talks on Gita by Vinoba Bhave. It is one of the best book, or one of the simplest book rather, on Gita, which has a life-changing impact if somebody reads it 5 times. So I would strongly recommend that book to everyone.
And right, sir.
Sorry,
So,
Prince, I'm just taking one word over here. To be very honest, Vikas sir writes letters are like there are gold mine over there in insights. Do read them.
Yes, please do subscribe to our newsletters. You will get very good insights. Like Prince was saying. Yeah.
yeah, I have pinned that tweet from sir, and guys can access that over this pinned tweet. So Vikas sir, like you being into, I mean, marathons and practicing yoga, playing poker, and all. So how you manage time out of the hectic schedule, which we assume and the lot of research and meeting people and companies, etc. demand.
No, it's again about compartmentalizing your life, right? So if you can't spend 2 hours in a day on your own well-being, what time you will spend? If you can't take care of your own health and mental health and physical health, how can you take care of somebody's financial health, or for that matter, anybody, right? So ultimately, people who say I don't have time for myself are either fooling themselves. They are fooling themselves. I mean, ultimately, so you have to take care of. And I can tell you, a lot of time people say I don't have time, but more time you spend on doing meditation, yoga, or in a physical and mental well-being, more effective you are on your job. So the investment of 1 or 2 hours, whatever time you do, actually it does not take away your time. It increases your productivity and it makes you a lot more efficient. And that's the sense. If you do meditation 1 hour, I can tell you everybody's sleep will reduce by at least 1 hour. So it's not about time, it's about commitment to your own well-being. And I always tell youngsters, I tell everybody that if you believe in investing, if you are passionate about investing, like you want to compound your capital, you must compound your health. Longer you live, you will be more richer. As we all know that Warren Buffett became compounded 80% of his wealth only post he became 60, right? So if we live longer, we will be more richer. So, and if you live happier, that you can do only if you have perspective about life. And hence, at least I try to read a lot of spiritual stuff. I try to read, I mean, essentially you have to take care of emotional health and you have to take care of physical health. Rest, I think, automatically will fall in place.
Great, great. So, sir, if you allow, I read out one, two more questions which we can take from the comments, which were sent by the attendees in the comments previously. If you allow only that.
Sure.
Yeah. So one question is from investment books is asking how much of macros do a retail investor needs to know so as to do sound investing? How much weightage you give to macros at Carnelian?
We do study macros. Macros only tell you to the extent of knowing where the wind is blowing, which direction the wind is blowing, right? Rest, I mean, then everything else is boils down to business sector, company, and all those things. Retail investors should not pay too much attention. They should just give money to the professional money manager. If they are investing, then they should do, full time, according to me, or they should devote a lot of time. I think if you just put money in the mutual fund, it's the best, according to me. If you have time and capability, then you should do.
Right, sir. There is one question on corporate governance. So he's saying corporate governance improve as companies scale and grow. So where do you draw the line in corporate governance terms? What is acceptable and what is not?
Well, that is a very long question, but it's like this again. मतलब आटे में दाल है, नमक है कि नमक में आटा है, right? Now, some amount of what is the basically, what is the tolerable limit again depends on, uh, we will never like any sort of massive related party transactions. We will not like, but if somebody is doing, let us say, you know, less than 0.01% of, let's say you're taking salary or rent or something, it's insignificant, right? So again, materiality is what you see, intent is what you see, and repeated intent is what you see. That somebody is doing, is it a repeated thing, one of thing, material, immaterial. So, you should not become too uh, uh, rigid about everything, but materiality is the most important and intent is the most important part.
Right, sir. So we are done with the questions, sir. And any concluding remarks from your end, and I your time.
No, I think thank you very much, Prince, for hosting me. And I think people have been very, very patient listening to my blabbering for last 1.5 hours. So thank you very much for hosting me. And thank you everyone for listening so patiently.
Thank you so much for sparing time for us and sharing your valuable experience and insights, sir. And surely look forward to have you on session again sometime down the line to your convenience. So with this, I take your leave. And guys, you can surely check out the letters which has been suggested. So and also, sir had shared wonderful insights with us. So you can check out the handles, and surely you will love the information being shared. And you can follow sir on his handle. And if somebody is interested in the services offered by Carnelian, they can also get in touch with sir. So thank you so much again, sir. Good night. Take care.
Thank you. Good night.